Hi everyone and welcome to chapter 2. In this chapter we are going to discuss about the Canadian financial marketplace. How does it work? What are the key concepts here that you need to focus on? So let's start. So first of all, what is investment capital? So capital is nothing but wealth. So wealth is money that is invested. For example, if you have a real estate, if you have a house, that's your wealth. If you have a commercial real estate, let's say a shopping center, that's wealth. Then if you have stocks, shares or equity, then that's wealth. If you have, let's say, gold bars, that is wealth. If you have bonds that you have invested in, that is wealth again. So capital is nothing but wealth. So capital represents the invested savings of individuals, corporations and government, and is arguably the world's most important commodity. Therefore, capital is extremely selective and it can be real. For example, you can own land, building and machinery, or it can be representational. So like it can be money. Currency is our faith in the government. Stocks, these it's investment in companies, taking part of the company. Bonds, investing in debt of a company. And mutual funds is collective vehicles that invest your money. So this is important that capital or wealth can be of individuals like you and me. It can be for companies like, let's say, wealth of RBC or wealth of Tesla, or it can be for governments. So sovereign wealth funds are examples that come into my mind. Sovereign wealth fund means governments run a fund that invests in different projects and stocks and etc. Okay. So capital has three important characteristics. It is mobile. It means that it can move anywhere and that too quickly. It is sensitive to its environment. So whatever environment is there, right, like we are in the pandemic right now, so the capital is sensitive to that. So maybe generation of capital reduces during such situations. It is scarce. It doesn't grow on a tree, as your parents said. Okay. Now, country risk evaluation. So risk factors where capital will go. So mobility. So what does this mean? So capital will always try to make a trade-off between expected returns and risk. So if it is getting risky but the returns are not improving, then the capital will take flight. So it will move out of it, right? If returns are increasing, risk is going down, quality is improving, capital will come there. So it depends on a lot of things, like capital inflows and outflow depends on a lot of things. It depends on political environment. Means example, Venezuela, there was a capital flight from Venezuela. Why? Because the political environment, the economic environment was not good. Are you involved in internal or external conflict? There is a war going on between Armenia and Azerbaijan. So because of that, capital flight is taking place from those economies. Then it can be economic trends, GDP, how the gross domestic product is developing. In like Lebanon comes to mind. So Lebanon is in economic crisis right now. So Lebanese economy is struggling. So that also will impact capital inflows and outflows. Inflation, hyperinflation. Zimbabwe had hyperinflation, because of which capital left. Levels of economic activity is also important. Fiscal policy is policies that are taken by the government. So taxation policy, if people start taxing more, generally capital takes flight. Government spending, it also depends on where the government is spending and doing what. Monetary policies are conducted by central banks of the country. Fiscal policies are conducted by the elected officials. Monetary policy is conducted by central banks of the country. Now, monetary policy and fiscal policy are likely to be independent. They may or may not be in the country that you're looking at, but they are ideally independent. So there is a central bank who does monetary policy, Monetary policy deals with how much money supply and how much credit supply is there in an economy. And fiscal policy deals with taxation and government spending. So monetary policy includes money supply, price stability, focus on inflation, investment opportunities, satisfactory returns, which is generally risk driven. We have discussed the risk return trade off. So if risk improves, like if risk goes down and returns stay the same, capital will come there. Labor forces, skilled, productive and adequate supply of labor also improves a country's standing. Now, what are the sources and uses of capital? The only source of capital is savings. So savings are done by individuals. Savings are done by individuals like at their end, or they collect their savings in a pension fund or a mutual fund, right? So these are the sources of capital for a country or for users. So sources are lenders of capital and users are people who borrow money. So savers, saving population, individuals, pension funds, mutual funds, these are sources of capital. Now who are the users? Users can be individuals. Again, you can lend money to your friend in which you are the source and your friend is the user, or it can be a company, or it can be governments at all three levels. It can be city level officials, municipal level officials, provincial officials, as well as federal officials. So non-financial corporations such as manufacturers, food distributors generate the largest part of total savings, which they retain in their business or reinvest. Because these funds are internally generated, they are not usually available or invested in other businesses. So businesses also generate some savings, but most of the times they reinvest their savings into their business to grow. So in that case, the savings are not available for external users. Individuals may decide to save, postpone consumption so that they can consume in future if they expect returns. So you decide not to spend that money but to save it because you expect your money to grow. Government that generates budget surpluses can use those funds to save for a future need or to pay down existing debt. So Canada hasn't run surpluses for years now, but provincially if you look, Quebec has run surpluses for last couple of years in the duration of 5 years. So when you run surpluses, you generate savings. So either you can invest it or you can pay down debt if you have savings. Governments that generate budget deficits will need to borrow and finance those deficits. So if you look at Canada, you can actually see the borrowing that the Canadian government is doing. So this is the Canadian debt clock. So it will show how much federal debt is there, how much money the federal government has borrowed. So it is over $1 trillion right now, and per individual, per citizen share is $26,000 that the government of Canada federal level has borrowed. So this is just the federal level. You can even look at provincial clocks. So if you look at, let's say, Ontario, so this clock is separate than the federal. So $385 billion is the borrowing for Ontario. So you have borrowing at federal level for the government, you have borrowing at provincial level, and you may have borrowing at city levels too. Now it is little different in United States. In United States, generally cities are not allowed to run a deficit. So borrowing mostly happens at the federal level. But there is like unfunded. So it's little complex. Okay. Now there are three major sources of capital like we discussed. They are retail investors, individuals who buy and sell securities for their personal account with small amounts of money. So it's you and me. You and me, individuals save, right? And then they invest their money. So investment can happen in real assets like real estate and other gold and all those things, or it can be happening in representative assets like stocks and bonds. There can be institutional investors, organizations such as pension funds, life insurance companies, mutual funds that trade large amount of securities with large amount of money. Or it can be foreign investors, are a different source of investment, mainly with foreign direct investment, in which funds are used to start up or buy existing companies in the industries such as manufacturing, natural gas, and retail. The users of capital can again be individuals, businesses, and government. Individuals, capital is needed to acquire major assets such as housing, consumer durables, and other types of consumption. So if you're planning to buy a house, you may take a mortgage. So mortgage in that case is borrowing, is using the capital of someone else. Capital is usually obtained through personal loan, mortgages, or charge accounts, that is credit cards. Businesses need massive amount of finance to do their day-to-day operations, which is called as working capital, expand and maintain plant and equipment, which is the capital spending. Much can be generated internally through profits. The rest is borrowed from banks by using securities such as short-term money market papers for short-term borrowing, medium and long-term debt, and common and preferred stocks. So debt can happen short term for a company by issuing money market instruments. It can happen through debt financing, bonds, as well as loans from banks, or it can happen through security issuance, that is issuing stocks. Stock is you're giving ownership of your company to an investor and taking money from him. Governments are major issuers of securities in public markets, either directly or indirectly through guaranteeing the debt of their crown corporations. So in Canada there are certain crown corporations. Crown corporations means these companies are run by the government of Canada. For example, Canadian National Railways. So that it's a crown corporation. So railways is run by the government. So either railways can issue debt or use debt, right? Or the government can issue debt. So government are major issuers of securities in public market, either directly or indirectly through their own doing or using crown corporations. Government borrowing occurs at three levels: federal level, at Bank of Canada level, provincial level, let's say Ontario, Alberta, BC level, and municipal level like Calgary, Toronto, and Montreal, etc. Federal government, when revenues, taxes mainly fail to cover expenditure, or when large capital projects are planned, the federal government must borrow money. The federal government makes use of four more major instruments. They can use treasury bills. Treasury bills are short-term bills that are issued in money market, right, to get money for the short term. So it is generally less than 90 days. Marketable bonds, so it's little longer term. Canada savings bond and Canada premium bonds, these are longer term bonds. Provincial governments, like federal governments, provinces issue debt directly. They borrow for the same reason: tax revenues are falling short of spending requirement, or for large capital projects that are planned. For example, Montreal is planning a new, let's say, railway line, new metro line, right, subway line. So in that case, it needs money to construct that line. So where is it getting money for doing that? It is borrowing money. They tend to borrow by issuing bonds through a syndicate of investment dealers to financial institutions, institutional investors, or retail investors. Now, Montreal in this case is mostly issuing debt to a pension fund. So pension funds are buying that project, and whatever revenues that are going to be generated from the project will go to pension funds. Some provinces can issue their own short-term treasury bills or their own versions of saving bond. Municipalities, many of the projects that municipalities undertake, streets, sewers, transportation, delivery of utilities, are expected to last for 20 years or more. Municipalities attempt to spread their cost over a long number of years and finance them to selling debentures, which are similar to bonds. Municipalities have the same challenges as provincial and federal governments do. Their cash receipts do not cover their expenses. Next, financial instrument securities. Securities are formal legal documents that are ways in which capital can be distributed between sources and users of capital. So it's an agreement between people who are giving funds and people who are taking those funds. Securities set out rights and obligation of their buyer and their seller and have standard features that facilitate their trading. There are 5 main types of securities. Debt instruments. Debt instruments are nothing but loan. So as an investor, you give your money to maybe a company. Company borrows money from you, and for against your money, you get regular interest. That is debt. Equity investment is selling of ownership. So a company, let's say Tesla is issuing some shares. So Tesla is giving up ownership against some money. Tesla is a company. So Tesla is giving up ownership against some money. So if you actually see, so in Canada, the largest market cap company is Shopify right now. It used to be Royal Bank of Canada, but Shopify has gone up significantly and it has become the largest market cap company biggest company in Canada. So if you buy Shopify shares, it is $1,500. It is traded on Toronto Stock Exchange, TSX. So if you buy this stock at 1537, then you're taking ownership of Shopify. You're giving money, but against that money, you're getting ownership. Then there are investment funds. Investment funds means you give your money to a fund manager. The fund manager collects money from different investors, and then the fund manager invests that money on behalf of those investors. So everyone is collaborating and giving their money to a particular fund manager. That fund manager is investing that capital somewhere. So if you look at it, so this fund I really like. So it is an innovation ETF. It's an innovation fund. It means if you buy this stock, you're giving money to ARK. ARK is the company that is managing it. You're giving your money to ARK. ARK is getting money from different investors, and the manager of ARK, that is Kathy Woods, take decisions on where to invest on behalf of you. So it's not their money, it is investors' money that they invest, but they charge fees for doing that. So if you see, 0.75% is the fees that they charge to do that. Then there are derivatives. Derivatives are instruments to speculate and to hedge. So either you can speculate on stock prices, or you can stock or commodity prices, or you can hedge your risk. An example for that will be, let's say this is Tesla. Call options are instruments where you bet on prices going up. Put options are instruments where you can bet on prices going down. So in this case, we are looking at call options. So call options of Tesla. Tesla's current price is $659. So let's say we look at a call option of $660. So this call option is trading at $15. So if you buy this call option, you're betting that price will go above $660. If that happens, you make money. If it doesn't happen, you lose money. So it is like speculation and risk management using options. So same way you can look at put options too. So these are puts. Call options are way to bet on prices increasing. Put options are ways to bet on prices falling down. So in this case, you can buy a put of 600 at $2. So if price goes below 600, you make money. If prices go up or stay the same, you lose money. So calls and puts or options are ways to take speculative or hedging positions. There are other financial instruments too. So first is financial instrument debt, also known as fixed income securities, because interest is a fixed thing. It may not be fixed. There are real return bonds which depend on inflation and interest rates, but generally it is fixed. You can estimate the income. They formalize a relationship in which the issuer, the borrower, promises to repay the loan at maturity. So if you're giving your money, if you're buying some company's bond, let's say you're buying RBC's bond, then RBC is promising to pay you back when the term matures, and in the meanwhile it will keep on paying you interest. The term of the term of the loan ranges from very short few days to a very long term, 30 years and beyond, depending on type of instrument. So this is an example. Okay, so actually we can see a bond issue. Instead of doing that, okay, so this is an example, like how much bonds were issued in different years. So in 2020 the bond issuance has gone down. It is significantly lower than 2019, but still some bonds were issued. $46.7 billion worth of bonds were issued. One of the recent bond issues that comes to my mind is Carnival Cruise Lines. So Carnival Cruise was struggling because of pandemic. It needed money to survive. So it did a bond issue in which it raised some money. Primary examples includes bonds which are backed by assets, debentures, mortgages. Bonds are backed by specific assets of a company. Debentures are like bonds, but they are not backed by a specific asset. Then there are mortgages that you take against real assets like house, treasury bills and commercial papers. These are short-term borrowing instruments. Then financial instrument equity. Equity is nothing but buying ownership in a company, usually referred to as stock or shares, because the owners actually buy a share or piece of company, gaining them a stake in the company. As a owner, the investor participates in the fortune of the company. If company does well, the value of company may rise, causing the market value of the shares to rise, giving investors a capital gain when the shares are sold. The company may distribute profits using dividends. So when you invest in a stock, there are two ways you get returns. One way is company is making some profits in that given year. Out of those profits, it may distribute something to you. So as an investor, I may get some distributions from the company I'm investing in. So that distribution are called as dividends. Along with that, the share price may also rise if the company is doing well. So as an investor in a company, you get returns in two forms: dividends, that are distributions from the profits, or share price increase. Now if you look at that, so let's say we invested in the largest bank in Canada. TD is coming close, but it is RBC is still the largest bank in Canada. So if you invest in RBC, what do you get? You get ownership in RBC. So if share price for last 5 years or last 1 year after the COVID-19 fall coming up. So if you bought RBC here, you got appreciation in share price because RBC is doing well. Along with that, you also get dividend. So this is the dividend. It pays 4.15% dividend. So you get share price increase as well as dividends. Okay. Unlike interest payment on debt, dividends are not obligatory. They are not a fixed thing. There are two main types of shares: common shares, in which you participate in an appreciation, and preferred shares, which is little different. We are going to discuss it in little further details, but right now preferred shares have fixed rate of dividend and preference in dividend. Generally, common shares do not have a fixed rate of dividend, and they have lesser preference in terms of dividend payments. So if a company is making some profits and it has two types of shares, preferred stock and common stock, it will first pay dividends to preferred stock. The next concept is investment funds. So what are investment funds? Investors are contributing their funds, right? A fund manager on an investment firm is collaborating those funds, and then the fund manager makes investments. Okay. So an investment fund is a company or trust that manages investments for its client. So it takes money from investors and manages the money on behalf of those investors. The most common form is an open-ended fund, also known as mutual funds. Mutual means held in common by two or more parties. The fund raises capital by selling shares units to investors, and then fund invests the capital. So funds generally sell their shares, right? Investors buy those shares by giving funds the money. Funds gets that money and then makes investments. As a unit holder, investors receive part of the money that the fund manager makes from funds investments. So example will be that ARC thing that we were discussing. So ARKK, ARC Innovation Fund, is a fund that is managed by ARC, which is an investment firm. Now, if you look at it, the price is 131. So it is selling its shares to get money from investors. So if you buy this share, right, buy this fund, you have to pay $131. So when ARC gets those funds, it will make investments. So where is it making investments? So ARC generally makes investments in innovative companies. So if you look at holdings for ARC, so top 10 holdings they have given, right? There are other holdings too. So they have made investments in Tesla. Then this is Nvidia. So it's like an genomic company, Square, Roku, Teledoc, all these companies they have made investments in. So what is ARC doing? ARC is selling its shares to investors. When investors buy those shares, ARC gets money, right? And that money ARC is using to make investments. And whatever returns ARC makes, those returns belong to shareholders. Now, will ARC do it for free? The answer is no. They are charging you fees. So fees are 0.75% for every dollar invested. Okay. So if you make $1,000 investment in ARC, you'll be paying $7.50 every year, right, as fees. Next, derivatives. Derivatives are mainly suited for sophisticated investors because they are speculation tool. We discuss, you buy a call option when you think price is going to go up. You buy a put option when you think price is going to go down. So it is like speculation, but speculations are risky. If the price doesn't go up, your call option becomes zero. And if price doesn't go down, your put option becomes zero. They are investment products that are based on or derived from an underlying instrument such as a stock or an index, but can also be based on commodities. So derivatives options you can buy on stocks, on indices like TSX 60 or S&P 500. These are indices. Or you can buy it on different commodities like gold and silver. The most common types are options and forwards. The average investor will seldom venture into these type of investment products because their need for great deal of education and willingness to take higher risk and often have high cost to purchase. Other financial instrument, investor dealers have used the concept referred to as financial engineering to create structured products that have various combinations of debt, equity, and investment funds. We are going to discuss structured products a little bit later. Two most type of popular products are linked notes and exchange traded funds. You have an assignment that is coming up based on ETFs. Okay. Next, what are financial markets? So all these instruments that we have discussed, like stocks, bonds, funds, they have to trade somewhere. So financial market is a place where trading happens. So securities are key element in efficient transfer of money from savers to users. The benefit of investment products depend on the existence of efficient market in which these securities can be bought and sold. So example, so for stock specifically, in Canada you can trade on 3 markets, right, or 3 or more markets even. Like first is TSX. So if you look at our RBC, so RBC trades on in Toronto. So equity Toronto, that is TSX. You can buy RBC there. Okay. Tesla is an American company. So you can buy Tesla on NASDAQ. It's traded on NASDAQ. And you can buy some non-tech companies like banks on NYSE, New York Stock Exchange. Okay. So stock exchanges in North America are mostly TSX, Toronto Stock Exchange, then NASDAQ and NYSE, New York Stock Exchange. Canadian companies trade on TSX, American tech companies trade on NASDAQ, and non-tech American companies trade on mostly on NYSE. Now there can be crossovers. A company can trade on 2 or more exchanges also, right? These were stock exchanges. Now if you look at derivatives, so derivatives mostly trade in Montreal or Chicago. So there is a Chicago exchange as well as a Montreal based exchange where derivative tradings mostly happens. So benefits of investment product depends on existence of efficient markets in which securities can be bought and sold. A financial market provides a forum in which buyer and seller meet, mostly not face to face, electronically, instead of intermediaries such as investment advisors or dealers, right? They can act on behalf of clients. Security markets do not normally involve a physical place. Most of it is electronic now. The capital market is made up of individual markets, mainly stock, bonds, and money. In addition, securities are sold in primary and secondary markets. The primary market is where new securities are issued by the companies, and secondary market is where those securities that are issued by companies are traded. So when a company sells stock for the first time, that is called as an IPO. Recent IPO was Airbnb. So Airbnb was not a publicly traded company. It was privately traded company. Then it issued its stock to investors by doing an IPO process, by doing an initial public offering process. So investors who thought that the company is good bought that company. Now Airbnb is traded in secondary market, that is, it is traded on exchanges. So if any investor wants to buy now, they have to buy it from existing investors. So how does it work? A company is initially private. Then it makes a public offering. What is a public offering? It issues shares to investors. So in a public offering, you are directly buying it from the company. And once investors have bought it, then they start trading their shares on secondary market, that is exchanges. So company sells stock for the first time in primary market. It is known as IPO. Mutual funds are also sold in primary market. The secondary market is where investor trade securities that have already been issued by company and government. For example, we were talking of Tesla. So if you buy it on NASDAQ, you are buying Tesla from some other investor. You are not buying Tesla from Tesla's like the company. You are buying it from some other investor who has already bought Tesla from company. So whenever you trade in secondary market, whenever you buy and sell stocks on exchanges, you are not giving your money to the company. Company gets money when they do public offerings. Okay, the issuing company or government does not receive any proceeds from transactions in secondary market, as issuers receive payment when securities were first issued in primary market, when those investments were first made available to the public. Markets can be divided into auction markets and dealer market. Auction market involves buyer entering bids and sellers entering offers for stock. So it's like whoever wants to buy put their bids, whoever wants to sell put their offers, and then matching happens. The price at which stock is traded represents the highest price the buyer is willing to pay, the bid price, and the lowest price the seller is willing to sell, that is the ask price. So order matching happens between highest bid and lowest offer. These orders are channeled into a single central market where they compete with other bids and offers. Canadian Stock Exchange. A stock exchange is a marketplace where buyers and sellers of securities meet to trade with each other and where prices are established according to laws of demand and supply. So if demand is more, the stock goes up. If supply is more, the stock comes down. Trading is carried on in common and preferred shares, rights and warrants, listed options, future contracts, installment receipts, exchange traded funds, income trust, and few convertible debentures. Liquidity is fundamental to operations of exchanges. A liquid market is characterized by frequent sales, narrow spread between ask and bids. So if you look at Tesla, the ask and bid spread, okay, so bid is 259 and ask is bid is 259.27, ask is 259.72. so the spreads are very narrow. What does that mean? That the market is extremely liquid. If the spreads are large, then the markets are not that liquid. The market for Tesla is extremely liquid right now because it's a big company and it is traded on S&P 500 now. Okay, narrow spreads and small price fluctuations from sales to sale. Canadian exchanges, TSX. TSX is the exchange where mostly Canadian large and medium sized companies are traded. TSX Venture Exchange is a exchange, again Canadian, but small companies are traded. Alpha Exchange is a substitute of TSX, like you can either trade on TSX or on Alpha. Canadian Securities Exchange, CSC, is also a exchange. Montreal Exchange is where mostly derivative trades happen. Then Equitos Neo Exchange is there and Natural Gas Exchange is there. TSX and TSX Venture and Montreal Exchange are the three major ones. TSX lists senior equities and some debt instruments. TSX Venture trades junior securities and few debentures. The Alpha Exchange is an alternative platform to TSX and focuses on technology and financial companies. The CSE specializes in emerging newer companies. The ME trades all financial and equity futures and options. So Montreal Exchange mostly deals with derivatives rather than stocks. Equitos Neo provides listing and trading services for securities listed on its TSX and TSX Venture Exchange. The Natural Gas Exchange is North American clearing operation for energy contracts, where energy contracts are traded, and they mostly trade in Calgary based NGX. The dealer market, so example for dealer market would be NASDAQ or over the counter. So dealer market consists of networks of dealers who trade with each other, usually over phone or computer networks. Unlike auction markets where individual buyers and sellers orders are entered, a dealer market is a negotiated market where only dealers bid and ask quotations are entered. Almost all bonds and debenture trades are sold through dealer market, which are less visible than auction market or equities. Dealer markets are referred to as over-the-counter or unlisted markets because the securities are traded are not put through an organized exchange. Now, a good example for that will be GBTC. Now, Grayscale Bitcoin Trust. So, it's a trust that holds Bitcoin and you can buy and sell Bitcoins using this instrument. Now, this is an over-the-counter instrument. So, it's not traded on exchange, but it is traded over the counter. Over the counter means that mostly dealers buy and sell this instrument between them. It doesn't go through the exchange route. Okay. Money market, usually debt maturing less than a year, trades in money market and is mainly government debt such as treasury bill, but also includes bankers acceptance and commercial papers. Long term capital market, stocks that trade on exchanges and bonds that trade over the counter. Derivative markets, financial and equity futures that trade in Montreal Exchange, right? Now, the biggest market amongst all of this is foreign exchange market. Currency market is the biggest by transactions. It is the biggest market in the world, right? Foreign currency trades involves mostly banks, dealer houses and exchanges, currency exchanges, and they trade, individuals trade it, like corporations, big companies, everyone trades, but volume wise it is the biggest. There are organizations that assist in transferring of capital between suppliers and users. So there are deposit taking intermediaries who take your deposits and use that deposits to give out loans or to invest. So that can be banks, trust companies like mutual fund companies, and credit unions. Non-deposit taking intermediaries, this can be investment dealers and brokerage firms, life insurance companies and investment firms. Role of investment dealer. There are another type of non-deposit financial institution that are also known as brokerage firm, security houses and investment banks. They help to transfer capital from, so brokerage is where you arrange, buy and sell sites. So you try to be a bridge between people who want to buy and people who want to sell something. So they help transfer capital from savers to users through the process of underwriting and distribution of new securities which take place in the primary market. They maintain secondary market in which previously issued debt, right, outstanding can be traded among investors, enabling the security market to have liquidity, the ability to buy and sell security with ease at a reasonable price. Now, Canadian regulatory framework. So there are different regulations that you have to be aware of, and we are going to discuss them a little bit further in the course. So federal government has Consumer Protection Act, so which protects the consumers. So if you have any complaints regarding a product, then you can go there. There is a criminal code that deals with criminal activities in the market. There is the Bank Act, which governs different banks, and Canadian Business Corporations Act, which governs different businesses. Then there are provincial and territorial government, provincial and territorial security administrator. Now this is difference between Canada and United States. United States has a federal body that deals with stocks and companies, like that is called as SEC, Security Exchange Commission. In Canada, we do not have a federal body, we have provincial bodies. So each province has different provincial body that deals with the same function that SEC does. But they are not separate, they do interact with each other. But it is a loose interaction rather than having a central thing. The provincial and territorial security administrators are there. Registration, disclosure, investment and prosecution is done by them. They are responsible for administration of Provincial Security Act. So each province has its own separate Provincial Security Act and they are responsible for dealing with violations of those acts. Now there are SROs that generally governs their members. For example, if you start selling mutual funds, you become part of an SRO like MFRDA, or if you are selling stocks, you become part of IROC, and then they govern your behavior. SROs are private industry organizations that regulate their members to ensure that members follow rules. If the rule in an SRO differs from provincial rule, the more stringent rule applies. So let's say the provincial rule says that you can only buy 5% stock in a company in which your wife works, and the wife is a director. And let's say the SRO rule says you can buy 10%. Now, whichever is the strictest, you have to follow that. MFTA, Mutual Funds Dealer Association, oversees the distribution side of mutual fund. IROC, Investment Industry Regulatory Organization of Canada, regulates members who sell investments including mutual funds but also stocks and bonds. So if you are only dealing with mutual funds, generally you register with MFTA, but you also deal with stocks and bonds, then you have to register with IROC. In Quebec, it's a different body, AMF, and Chamber Securities Financier, that, ignore my French, I can't pronounce those words. They separately regulate mutual funds. So you have to remember, in Quebec there are different bodies than pan-Canadian bodies that do it. So thank you for listening. See you in the next session.